Pop quiz. A bakery has extra capacity, and a customer offers a low one-time price for 500 extra cupcakes. Should the bakery accept the order? A. Always yes. B. Always no. Or C. It depends on relevant costs and benefits. Lock in your answer. We will come back to it. In this video, you will learn what short-run decision-making is, why it matters in managerial accounting, and how to use a simple 5-step model to make better business choices. We make decisions all the time. In business, managers do the same thing, but their choices can affect costs, revenue, and profit right away. That is why companies need a clear process instead of guessing. A short-run decision is a tactical choice between alternatives that affects the organization in the near term. The goal is usually to lower costs, use resources better, or improve profit. Here is the model we will use. First, define the problem. Next, identify the alternatives. Then estimate relevant costs and benefits. After that, consider qualitative factors. Finally, make the decision. Let us test the model with a special order. Imagine a custom t-shirt company normally sells shirts at a regular price, but a school club offers a one-time order for 1,000 shirts at a lower price. Management now has a clear problem to solve. First, define the problem. Will accepting this order increase profit without causing bigger problems elsewhere? Next, list the alternatives. The company can accept the order, reject it, or try to negotiate. Now we do the financial analysis. Relevant items are the ones that change between choices, like extra materials, extra labor, extra shipping, and the added revenue from the order. Irrelevant items, like factory rent or past design costs, stay the same and should not drive the decision. If the extra revenue is greater than the extra costs required to fill the order may help short-run profit, but that is not the whole story. Managers still need to ask what else could happen if they say yes. A brief definition and example of opportunity cost, i.e., the contribution margin lost by giving up the next best alternative. Here is a common mistake. People assume that if a choice looks profitable right now, it must be the best choice. Not always. A short-run gain can create overtime, delays for regular customers, or quality problems. So far, we have covered what short-run decisions are, how the 5-step model works, and why relevant costs matter more than costs that do not change. Want to check your progress? Tap the link for a quick practice test and a concise study guide tailored to this lesson. Quiz yourself, skim the highlights, and jump back in. Back to the pop quiz. The best answer was C. It depends on relevant costs and benefits. A low price is not automatically good or bad. If the bakery has unused capacity and the extra revenue covers the extra costs, the order may make sense. Now let us apply the same thinking to a different short-run decision. Make or buy. Suppose a company makes one component in-house, but a supplier offers to provide that same part for less than the full internal cost on paper. The key is to compare the supplier price with the costs the company can actually avoid. If some internal costs will remain either way, they are not relevant to this choice. That means managers should not compare the supplier price to every cost listed in the accounting records. This is where qualitative factors matter again. Maybe the supplier is cheaper, but delivery is unreliable, quality is inconsistent, or the company loses too much control over the product. The cheapest option today may cost more tomorrow. The best short-run decision usually comes from combining both sides of the analysis. First, estimate the financial impact. Then weigh the qualitative effects. A smart manager does not use numbers alone or instinct alone. They use both. To recap, short-run decision-making means choosing among alternatives with immediate impact. Use a step-by-step model. Focus on relevant costs and benefits. and never ignore qualitative factors that could affect the business later. Now that you've watched the video, let's see how much you remember. Head to the link in the description where you'll find Quizlet content made just for you.